Okay, so second video. This time we're going to be covering the back tester that I coded up. If you guys look at the website, you can see that I completely overhauled the UI. Before it was really bad, now it's a little better. It's not where I want it to be, but it's getting there. That's what matters. So back testing. That's what we did this past week. And I'll be going over some strategies that people commonly use and how you can adapt them to your own uses as well. So first thing, the most common strategy, buy and hold. You buy a stock, you hold it, that's it, right? You don't do anything else. And that's the whole thing, it's the whole game. And often that outcompetes most strategies. If you guys look at hedge funds, they have something called alpha, which is how much over the S&P 500 they're able to get returns, and that's what really counts. So if you're not able to beat the market, if you're not able to beat S&P 500 buy and hold, you're not doing the right thing, basically. If you can just buy the market and you can do better than trying to play the market, then you're kind of better off just, not even trying to invest actively, just being a passive investor. For most people, that is the best option, but for the people who don't want to do that, there are some strategies that I'll backtest some strategies that people try to use, and then you can see how that really goes. So just do it with the S&P 500 based off of this strategy. What kind of returns are we getting? You can see that you would perform negative 38% below buy and hold. You can see the dip here this is just in the past year, but you can see that it's not necessarily very helpful just applying a EMA strategy. It's the most beginner friendly strategy, but it doesn't necessarily work. You can try it with other stocks as well. You can try Nvidia. Nvidia is popular now. That one definitely doesn't work. So you can see we only executed one trade, and it did provide a positive return of 37%. You held it for almost a year. You can see that there, and it got you a return, but compared to the market, you should have just held the stock, right? You can try something else. See, again, it doesn't necessarily help at all. See, one of the trades actually made you lose money, and overall, you would have lost money using this strategy. You can see the total return is a negative 1.88. Your drawdown was 35%. That's terrible. So another strategy that people like to use is mean reversion using the Bollinger Bands. And the way the Bollinger Band works, the bands work is that there are three lines. You have the middle band, the upper band, and the lower band. The middle band is the simple moving average, usually around 20 periods. And the upper band is 2 standard deviations over that, the lower band being 2 standard deviations below that. So it's just built on standard deviations, which is a statistical term, if anyone knows statistics. And the way it's built is that when it reaches the upper band, we're seeing that the stock is overbought compared to its average, because it's trading 2 standard deviations over its SMA, right? And if it goes below that, then we're seeing that the stock is oversold, and we should buy now because the stock is trading way below what its SMA value is. And so that's a common strategy that people use. Let's run down whatever stock I have this on. You can see the band window we're setting it here is 20, and the standard deviation 2. This is a very standard Bollinger Band strategy. And you can see this provided much better returns compared to the trend file EMA, but still you can see that it doesn't necessarily ever, for very small points in time, does it actually outperform the buy and hold. Right here you would have plus 5%, right there, it's plus 6%. That's the best you can do on Apple. And even then, eventually there's a stark separation there. You can see when it begins to diverge here, maybe during this period right here, the EMA, the Bollinger Band mean reversion would be possible during this market regime. But you can see it completely falls apart as the time goes on. So you can see there's a lot more trades on this one, and the average win rate was 68.4% for the trades that you're making. But again, you can have a strategy that has over 50% win rate, because that's all you really need is a 51% win rate. But if it doesn't generate alpha, it's useless. So in this case, buy and hold is way better. Just matching the market, like you'll have no problem just holding rather than trying to beat the market. So let's try another strategy, this time with American Airlines. This is a stock that has performed down for the past 5 years, right? So in the past 5 years, it's down 56%. So how will a strategy perform on a stock that trends downwards? Let's see. You can see that our strategy is significantly better than buy and hold. So if you were to apply the strategy on American Airlines, off of those trades, you would have made, like, see here, you would have been over 117%. Now you'd be up 115%. So you can see that a lot of the strategies are winning. Like your win rate is 77.78%. And you can see after the initial investment of 10,000, your stock would have grown to 11,673. So like your return would be 16%, right? But you'd be like, okay, maybe that's not the best, right? But compared to buy and hold, you're doing 100%, 120%. You're doing much better. And you can compare it right there as well. These are all the trades you would have taken in this time. So for something like that, when the stock is trending downwards, then yeah, this strategy worked way better. Let's try with another strategy. We can try the trend following EMA again. You can see here, even here, it's outperforming regardless. But the return is still negative. It's following the trend. The trend is, it's called trend following. The trend is downwards. It's gonna kind of go down. But even in this point, right, if you had applied this strategy, you would have still outperformed the buy and hold. What about RSI? The way RSI works is that, again, with the Bollinger Bands, if it's below 30, then it's oversold and you may want to buy, versus if it's over 70, it's overbought. So it'd be an opportunity to sell here. And you can see again on this one, you're still getting a negative. The return is still much better than just holding the stock itself. Sure, yeah, but you can see the drawdowns there are happening. You would have had some wins here, but it doesn't necessarily mean the wins are due to the strategy. It could just be the market regime is rewarding American Airlines at the moment right now. Coca-Cola is something that has historically gone sideways for a lot of times. So let's try that with our next strategy, which will be, well, we already did that. So we'll do momentum breakout. And so we buy when the price breaks the 50-day high. So basically what we're saying is the stock has been building momentum for the past 50 days. It's broken past its previous highs, and now is an opportunity to buy. And we sell when it drops below the 20-day low. And we can try this on Coke, which is historically moved sideways. You can see even here, you would have only lost like 70. You would have gained 45%, yes, right? But that necessarily wouldn't really matter, because buy and hold would have done you much better in this case as a stock that, although it goes sideways, it has trended up in the past few years. And we can just check that ourselves. Going Coke. Let's go past 5 years. See, you can see it's still just trending upwards over the past 5 years. Unlike American Airlines, which has just been, tanking downwards. That tragedy right there. So, what the basic point is that none of these initial strategies are able to give you reliable returns based off of the back test, because strategy that works today may not work tomorrow due to market efficiencies. So you can have a strategy, you can use Bollinger Bands on American Airlines, and it can perform well, right? Just as it was, as we were using it, and it can do good. and you'll be fine with that. But the issue is, you can also set stop losses here. So let's put an 8% stop loss, 8% 12%, run the back test. See, this one's way worse because our parameters are garbage. But let's just leave that for now. But you can see that even though it's you ended up peaking way up here, even though the stock was going, the peaks still follow the buy and hold trend. Like you can look here, the strategy went up, the buy and hold went up, and then it went down. It's the same thing. Oftentimes you're going to find these strategies are lagging because all of these indicators are lagging indicators. They only show changes after everything is already done. You can see the Sharpe ratio is really low there. So what does Sharpe ratio mean? It's the return you would get per unit of risk that you're inputting. It's uses volatility, uses the risk-free rate and a portfolio return, but you want high return with low volatility. Sharpe ratio is something that is really important to hedge funds because they want to maximize the Sharpe ratio as you would invest into a hedge fund because you want risk-adjusted returns. With risk-adjusted returns, you have a certain amount of risk you're willing to tolerate, and you're getting basically a percentage out from that. It's not guaranteed, but hedge fund is a much better chance of doing it. So that's why hedge funds don't necessarily need to beat the market. They're providing a risk-adjusted return. And so here the Sharpe ratio is 0.25, which is terrible. It's below 1. 1 to 2 is decent, 2 to 3 is good, like very good, and then over 3 is like very rare, like maybe a hedge fund would be able to get it. So you can see that's not the best, right? So our strategy, sure, it worked, right? But only in hindsight. And it doesn't necessarily mean it's going to continue working in the future. It's just hindsight. Everything is a lagging indicator. The only way to really have an edge in the market is to have information that the market hasn't taken in and accounted for, if you know what I mean. So that's something I'll be getting to in the next video. There's other indicators here. I want everyone to go and try them out for themselves. Use your favorite stock, and see if you traded like many people trade, right? A lot of people use Bollinger Bands and they say, okay, if the Bollinger Bands breaks over this point, then we buy, then we sell. The data shows that it doesn't necessarily mean returns. Actually, often it'll mean you'll underperform the market versus just holding. American Airlines being a rare case where you did get a much greater return versus buy and hold. Buy and hold, it's like 100%. And everything is, the trade logs even show it and back it up. But the risk-adjusted returns are very low. I mean, you're risking way more than you're getting out, and that isn't the best. So try out the strategies yourself. See what you like. See if you can learn anything from that. And in the next video, I'll get into some more creative strategies that I am proposing. These are very common strategies, but they aren't as simple as running an indicator and buy signal, sell signal. It's nothing like that. It requires some sort of decision making on your part. Of course, a computer can handle the trading itself, but it does require some thinking on the user. And that's it for this video. I'll see you guys in the next one.